Yo guys, welcome back to Stock Talk Insider. Today I want to talk about the stock market in its whole and where it's going, and actually just about inflation, rate cuts that may possibly happen in September, a little bit about some other points that I wanted to discuss, and just to start off, before I really start, just to start off the video, this is S&P 500, just to give you some thought. In the last 5 years, we had some pretty nice tips, but again, those actually don't matter, and in the end we just have 91% upside for the S&P 500, which is almost 100% on your money. So yeah, I just wanted to show you that. If you would have not yet seen it, it's really easy, just look it up. 91% in 5 years. There can be 1 to 2 years that are bad, but eventually in around 5 to 6, 7 years, you will always beat the market if you just invest in S&P 500, if you don't care about loose stocks. I do care about loose stocks. I just wanted to show you guys, if you've never invested in anything, this is S&P 500. But of course, most of you guys who watch this right now will also not only invest in S&P 500, of course, and will also know a little bit more about stocks and how they want to invest in those things. So yeah, let's just dive into the macro data and where the market's at now. If you take a trading view for this moment, this is the S&P 500 volatility, so the VIX. If we look at which period do we take? 6 months. It's pretty much to the lowest end it can be over the last 6 months. If we take year to date, literally the same also to the lowest possible levels. 1 year also. And if you know, actually 1 year long we thought that inflation was literally dead and gone, but at this point, literally right here, there is, because of tariffs and all of those things, we start to feel a little increase of volatility in the inflation, and not really the steadiness we expect to have a lot of rate cuts. So yeah, let's get right into that. I already made a video about why the Fed may not cut as much as people think, because they want to avoid stagflation, and they want to keep their grip on the market, because if they just start cutting like crazy right now, they will not have a grip on the market, and they will maybe in a half year need to start hiring rates again. So yeah, that was just some information I wanted to tell you guys that was in my head. Now this is literally the information I brought together to be as clear as possible. So we'll cover the major forces driving the stock market, the chances of a correction or a recession, the possibility of a continued bull run, the outlook of interest rate cuts, and how sticky inflation could change the game. So the current market landscape: US equities remain near record highs, with S&P 500 well above 6,000, fueled by strong tech earnings, AI enthusiasm, and investor optimism for policy support. Analysts on Wall Street have repeatedly revised their year-end targets higher, with some now pointing towards 6,600 to about 7,100 by December year-end. But there's the caution. Valuations are flashing warning signs. Forward price to earnings multiples are stretched, and price to book ratios are now above the levels we last saw during the dot-com bubble in 2000, which is a pretty big thing to say, of course. Also, the bullish case upside scenarios are that strategists at firms like Wellington, Altus, suggest that the S&P 500 could even reach 7,500 by spring 2026, citing policy reforms, AI-driven productivity, and growing adoption of blockchain and crypto. Market sentiment has been buoyed by a belief that the Fed will cut rates in the second half of 2025, supporting liquidity and valuations. No recession in sight. Morningstar and several major banks argue that the US economy remains resilient, job markets are stable, corporate earnings are holding up, and soft landing remains the most likely outcome of them all. Investor psychology: with so much momentum, Many traders fear missing out, a classic driver of extended rallies. And yeah, if you don't want to miss out, but you also don't want to get into a correction, don't invest. You will need to do both. So you need to invest and you need to go through the corrections to have a very good outcome in the next 10 years. Also, the first 10 years of your investing are just literally the most important, because only after 10 years, in normal senses, if you don't have years like 62, if you're not investing like, how do I say it? If you're not busy with looking up stocks, looking what the best stocks are, the best stories behind some companies or something, or which are the best opportunities, and you're constantly searching for information, then you're not going, if you're not doing that, then you're not going to have years like 60, 70, 80%, but you will have between 10 to 15% upside. And if you do things like that, between 10 to 15, then you'll probably have, after 10 years, more income than you can actually save on a year. So you'll have more profit on a month than you would normally save in a year. That's something that's proven. And if you're between 10 to 15% in gains each year, that's something that's proven. So yeah. The bearish case, which is something we'll also have to look at, of course, valuation risks. Bank of America warns of a bubble, pointing at stretch multiples across tech and growth names. Correction calls, Stifel predicts a 40% pullback before year end. I also believe that this year we will have a bull market probably. Well, if you look at the inflation numbers and possible rate cuts, all of that together, I believe that we will have a rate cut in September, and we will ignore a little bit of the inflation, because people are just saying that it's because of tariffs, and people are already used to the tariffs moves. So if they see this coming back into inflation, people will just say that it's because of tariffs and it will go away. It's just a matter of time. And again, actually inflation, you really have to start to be scared of it when it hit above 4%. Right now it's just, it's going higher, but the CPI came in good, PPI came in worse. So yeah, it's just a matter of how do you see against it, and it's just personal. Eventually markets will just go up and absorb everything that it's doing, and everything that it's getting to know of new problems. So yeah, I believe that there will be a rate cut, and we will have a very nice pullback in year end, and maybe even recover the pullback. So when you buy, you will get the better of it at the year end, but in between the rate cut and the year end, I probably believe that there will be a pullback. If not, we're likely literally going to have it in the beginning of 2026 probably. So yeah, it's just healthy. If you look at where the S&P 500 is right now, it's just gone up. I believe you can go even higher, like the 600, 700, maybe 800, but then we will just need or have a pullback, because it's just going to need to do that, and it will just be healthy. So why? August and September have historically been weak months for equities, and seasonality could amplify downside risks. But of course, well, it's so much percent out of so much percent that there's a chance that those things would happen. If it's 60% proven that the markets go down over so much years, then 40% it will go up. So maybe this is the 40%, and that August and September will just go up. If you look at August was literally a very good month actually so far, and I believe it will keep doing that unless there's some big drama or some big title. But for now, I do believe that we will keep going higher. Just in shockwaves, we will keep going higher. September will probably have a minimum of 0.25% rate cut, so 250 basis points. But We can also have none, but normally we will have one. But yeah, it's just how you look at the market and what you believe in, and eventually the market will do what it does, and the economy also. So the macro concerns are also there with the bearish case. So inflation data surprised the upside in recent months. Wholesale prices are at their highest level in 3 years. The ISM services index has dipped into contraction territory, a red flag for US growth. And stagflation risks, which is something that's being talked about a lot lately. Economists warn of a stagflation light, slower growth paired with rising inflation. That's actually just a describe of what stagflation is. Recession probabilities and economic fundamentals. Most economics do not expect a full-blown recession. Labor markets, while cooling, remain solid. Consumer spending hasn't collapsed, and AI-driven investments continue to inject capital into the economy. Also, the margins, like earnings with all of the companies, well, almost all companies had very good earnings. Margins are actually not weakening, they're growing. So yeah, of course, the consumer will have to pay more. That's just the way to go, and that's just how it works. If times get tougher, consumer will pay the end price of it. So yeah, that's just normal economy-based stuff. Of course, talking about inflation and interest rate expectations, inflation is sticky and would maybe return. But of course, as I said before, I'm literally just saying that inflation will be back if it's above 4%. Everything everything between, well, 2.9, 3% and 4% is just a little bit sticky, but above 4% is literally when it's coming back. So 4% is already a big number for inflation. We do want it at least to be between 2.9 and 2%. And of course, 0% would be nice, but that's not possible. So yeah, between 2 to 2.9 would be perfect. Now we're slightly above it. And of course, PPI is a little bit more above it than it should be. But yeah, rate cuts, when and how much. Future markets are pricing in rate cuts by late 2025, but expectations have been pushed back repeatedly. The Fed is signaling caution. They want to see convincing evidence inflation is heading sustainable lower. Treasury market calm. Despite inflation worries, bond market volatility has collapsed to historic lows, a sign investors believe policy will eventually ease. If you look at our conclusion and the investor takeaways, the summary of scenarios is we have a bull case, base case, bear case. Bull case is S&P 500 targets go between 7,100 and 7,500, powered by, of course, AI, resilient growth, and Fed easing. Taking all of that together, we would have that case. Going to the base case is a range-bound markets with bouts for volatility, modest gains possibly, but with choppy trading. Of course, the bear case, the one we all want to buy in, is a 10 to 15% correction, particularly in August, September, as valuations clash with sticky inflation and slowing growth. I don't believe it will go into correction in August. Of course, everything can happen. But I literally, as said in many videos before, if you get a rate cut, then we'll have a week of bullish upside after the rate cut, and then we'll just have more reasons to go down than we will have reasons to go up. So the market stands loose from the economy, so the market will do what it wants. But in the technical aspect, it would be very... how do I say it in English? It would be very logical if the market just went down a bit, made a little bit of a breather, and then went back up if there's no other big news. But just for technical purposes, that the market would just go a little bit lower and go back up to year end. But if there's some big inflation news or big no rate cut news or some new big tariffs or Trump does something else, then we'll probably have some big correction, which is in this case the bear case. But for August, I don't see something happening like that, or it must be something that's literally a black swan. But yeah. Some practical guidance from ourselves is that stay diversified, don't chase only AI or tech. Keep an eye on defensive sectors as a hedge against volatility. Follow inflation and Fed commentary closely. Rate cut timing could be the single biggest driver of markets in the second half of 2025. If you enjoyed the video, like, subscribe, and yeah, see you later. And before I literally close, this is the portfolio right now. Almost 24,000 in profit. The highest of this week was 25,250 in profit, which was around 57.5 thousand euros of total account. We made an old position again, so I bought around 226 stocks of Grab, which is around 1,000 euros. I want to increase it, and like this, we have two small caps, Grab and Honest, and yeah, I'm very bullish on those ones, but those are literally for 10 years holding. I will increase this for 1 year long, both of them. And yeah, then we're just going very hard in SoFi and AMD. And we have some side quests with Amazon, LBDs, and Shopify. Going further into that, yeah, this is how the portfolio stands, and I'm pretty steady in cash. And I like the way that portfolio is handled right now. And yeah, I'm literally just a little bit waiting on a correction. And besides that, I'm just buying every month a couple of times here and there. But when the correction comes into place, or even a recession in so many months, I will be cash heavy, most cash that I've ever had, and I will be adding more to it. And besides that, just invest a little bit like normally. So yeah, thanks for watching and see you later.